everybody. We've made it. The midway point of the year is here. Stocks have had a wild ride. The economy has done okay. We are so excited to discuss our mid-year outlook for mid-year market outlook for 2025. Uncharted waters. Sonu, let's just dive in. Are we going into a recession the second half of this year?
Short answer, no. We don't think so.
Good.
Right? We don't think we're going into a recession. Yes, there are data points I could take and say that, things are looking pretty bad. But on the other hand, you have data points that haven't crashed and burned yet. For one thing, the labor market, we just got June payroll data. The labor market is hanging in there. The big picture is the unemployment rate is at 4.1%. That's not bad. That's near historical lows, right? It's not going in the wrong direction, at least not right now, right? Yes, there are things I could pick out from under the hood of the labor market data and say, okay, things aren't all that great, and that is true.
Sure.
But the reality is we are at 4.1% unemployment rate. Yes, the growth of payrolls, growth of employment, wage growth have all eased. They've all softened, which means the economy is probably running below trend, maybe somewhere between 1.5% to 2%, whereas in 2023 and 2024, we had 3% GDP growth. Right now, it's likely to be somewhere between 1% and 2%. Again, that's not a recession, but it's and it should still be supportive of corporate profits, which is what matters for the market. But it's not gangbusters growth, right? But big picture is that's okay.
Well, again, let's remember 3 months ago, right now, when we're in the near bear market, had Liberation Day, what was the market pricing? And what was everyone on TV telling you, except for us, of course? There's a recession coming. It's going to get worse. So, okay, maybe modest growth. Doesn't sound great on the surface, but again, what's being priced in, that's why, again, we've come back to new all-time highs. So let's kind of talk about, that's the economy. Let's talk about policy now. We just had the one big, beautiful bill pass, but on the other side of things, we've got the Fed. Are they going to cut or not going to cut? Let's talk about policy for a minute or two, Sonu. Let's start with the big, beautiful bill. Why are deficits historically actually a positive, and we think could be a positive the second half of this year?
Deficits are very high, no question. It's running about 6.5% of GDP. With the one big beautiful bill over the next 2.5 years, we'll probably see deficits rise to about 7.5%, if not 8%, once you include higher interest costs for the government. Now, yes, we can come to what the bad side of that is. There is no free lunch, right? The bad side is basically higher interest rates and higher interest costs. And, the downstream impact on areas of the economy like housing affordability has crashed because mortgage rates are 7%. So, and there's no light at the end of the tunnel there, so to speak. But the reality is, over the short term, when the government is running deficits like this and increasing deficits at the margin too, that's going to be a boost for corporate profits. Right, it ends up, the public sector's deficit ends up as the private sector's surplus. In this case, the private sector's surplus, a big chunk of it is corporate profits, right? So that's good, and that should drive the stock market, which has already got some momentum, right? So I think that's a positive. Of course, like I said, the other side is all the tariff uncertainty, tariff policy. Will tariffs make it into inflation data or not? Everyone's still waiting, and most importantly, the Federal Reserve's waiting for that. And that is why we haven't seen rate cuts yet. When we started the year, we thought maybe we get about 2 rate cuts this year, could be 3. And we were hoping that would come during the first 6 months of the year. But as Fed Chair Powell recently said, if not for the tariffs, we would have cut. And they haven't.
The truth, the Fed's in a tough spot, right? We were earlier this year saying the Fed probably should be cutting, but with the tariff uncertainty and the big, beautiful bill and the higher deficits, there are some reasons the Fed hasn't cut. So we're watching that closely. If they do cut a couple times second half of this year, that'll probably be viewed positively. So we'll get there. We'll watch that as it pertains and as it continues. Let's go to the stock market, though. We came into this year expecting U.S. stocks to gain between 12 and 15%. We are still there. We are still saying that at the middle of the year, the S&P's up ballpark about 6% or so. So kind of right there. I want to really point out, though, in April, when everybody was cutting their targets, everybody's out there saying how bad it's going to be, recession's coming. We never did, right? We left our targets there. We've been overweight equities all year. We've talked on these very weekly videos of why we think stocks will continue to do pretty well when all things are said and done. We had a near bear market after Liberation Day, yes. But as we move forward, like we just said, Sonu, what drives long-term stock gains? It's earnings. Earnings are hitting all-time highs. Earning estimates going out 12 months are also extremely strong. Could there be some weakness and cracks? Of course, there could be, but the reality, the consumer is still solid. Like you started this conversation, people still have a lot of jobs. People are still employed. People are still spending money. All of that comes in with the stock market, and we don't think the stock market's overvalued either, because again, there are parts of the stock market that might be a little pricey, but earnings are justifying this bull market. What's one more reason you think stocks will do pretty well the second half of this year when all things are said and done, be up between 12 and 15%?
I mean, summarizing a lot of the stuff you said, it's momentum.
Yeah.
We've got momentum, we've got profit growth, and, hopefully we won't get a recession. And I think these three are catalysts for continued stock market, fairly strong stock market returns. I mean, we're not expecting anything like 2023 and 2024.
Right.
When the market is up 25%, it's 10 to 15%, but that's not bad after 2 big years, right?
I think well, especially where we were on April 8th, I think we'll take a 15% gain on the year. Two more quick ones, and then we'll talk about bonds and wrap it up. This is more real-time stuff that just happened. I looked when the S&Ps were called the sweet spot, Sonu, up between 5 and 10% right at the middle of the year. So a good year, but not like a terrible year or not like a really, really strong year. It's just a sweet spot. The rest of the year, so the final 6 months, is higher 13 out of 15 times. So again, that's important. But also when May and June are higher, like they just were. I think we mentioned this last week's video, but I'm going to do it one more time. When May and June are higher, the rest of the year has been higher 15 out of 16 times. There are some little clues, some little signals that the stuff that we've just seen in the late spring, early summer months that usually aren't all that great. Maybe it's a sign that this slingshot's in effect, this ball under the water, let it go. There is momentum, and it can keep going higher. So we've already said we like stocks second half of this year. Let's finish things up with bonds. Just so everyone remembers, interest rates lower, bond prices go up, and vice versa. So if the Fed doesn't cut, maybe bonds don't do as well. But why should we own bonds in a portfolio?
I mean, we are expecting a fairly strongish, I think, if that's a good phrase for it, second half of the year for stock returns.
Right.
Similar to what we had in the first half. But, expect volatility, right? Don't be surprised by volatility. And that's why we have diversified portfolios. And part of it is, say we're wrong about a recession, right? I mean, you're 100% sure that there won't be a recession. I don't think there will be a recession. But say we're wrong about that. What do you want in your portfolio to protect in that case? You want bonds. Because during especially a deflationary recession, interest rates will come down.
Okay.
The Fed will start cutting interest rates faster than they think they will right now. And that's going to be a boost for bond prices. Like you said, if yields come down, bond prices go up and vice versa, right? Yeah. So that's where you get your portfolio protection from. But at the same time, we could have inflation instead and the Fed doesn't cut. And in which case you want, things like managed futures, commodities, maybe some gold and other things that diversify your portfolio in addition to bonds, right? So I think diversification has been a quote unquote bad word over the last decade. It's paid to be concentrated in certain parts of the market. I won't mention which ones those are. Everyone knows what those are. But now is maybe the time to have a more diversified portfolio than anything.
Yeah, we've said it before, and I'll say it one more time, maybe end with this. When in doubt, diversify it out. There's a lot of doubt. There's a lot of confusion. And you look around the globe, this is a global bull market. Parts of Europe are doing extremely well. Just about every country. To be honest, we follow like 40 or 50 countries. Most countries are higher this year when it comes to stock market returns. U.S. has actually lagged. I think the U.S. probably plays catch up to a degree the second half of this year, but it's just a reminder why you want to have a diversified portfolio. And if you do, and if you follow your investment process, and I know all the listeners out here have some amazing Carson advisors that they work with every single day, then you follow the process. And all in all, this was not a fun year this time 3 months ago, but where we are now, we're in a better spot. We think the second half of the year is going to continue to be pretty good for investors and the economy. With all that, this was the latest Carson's Take 5, our mid-year outlook. We're really proud of this. Please let us know what you think about it. We'll see everybody next week. Take care.